retirement portfolio by Ryan Ennie and Jake Reed. And since Jake is out of town in Seattle till Monday, we thought it would be relatively easier. I walked us through the presentation since we tried a different method and technology is just not in our favor. The first step in our investing journey is to pick a broker. For our broker, we set up an online brokerage account through Vanguard. It costs $20 to set up an account, and this $20 is an annual fee that will continue until you have $50,000 of assets in Vanguard. Vanguard allows you to trade stocks, bonds, mutual funds, etc. Vanguard is also relatively low when it comes to fees and taxes because they have $0 trade fees, which means when you purchase a stock, it's $0, $0 fees per se. And also Vanguard allows automatic investing, which will it will reallocate our monthly funds for us so that all of our funds are even and spread out so that we don't put too much risk into one. All right, into the actual investing. During the first years 1 through 5, it's all right to be risky with your investments because you are young and you have lots of time to recover from made-up losses. So because of that, we're deciding to allocate our funds 66.6% U.S. stock funds and 33.3% international stock funds. And we are going to wait to accumulate our money to each year so that we have more money to invest in each stock fund. And our investment money for the first 5 years is $300 per month. All right, year 1 detail. In year 1, we are going to let our money accumulate till the end of the year so that we have $3,600. With that $3,600, we're going to be buying our first fund, Fund A. This fund is the Vanguard Growth Index Fund Admiral Shares, and we're going to be purchasing it for $3,000 because they have a $3,000 minimum investment rate. This fund is really good because it provides an assortment of different stocks in the U.S. stock market so that if one stock fails, the others could still be increasing and it's not as risky. Funds, however, do have some fees because they are run by a fund manager, so we will have to pay this fee, but even with, we still have a expected return of an 18.5%. Our expected returns are based off of they're based off of the 10-year average returns because obviously it's not possible to predict the future market, so we are making a rough estimate in our calculation. All right, in years 2 through 5, we are going to continue the same process by letting our money accumulate to the end of each year and buying a different fund for $3,000 at the end of each year. So at the end of 5 years, we'll have a total of 6 different funds. We'll have 4 U.S. stock funds and 2 international stock funds. International stock funds are more risky than U.S. stock funds, and U.S. stock funds are still risky, but this is okay since we're young and we can make up for our money at the end. At this point, we would have 6 different investments, 6 different funds, and our total value of investments has come to $23,000. So since it's still in the first couple of years, we are slowly starting to build interest and create money through our funds. And here's a graph of the money distribution within our funds, and right now it is pretty even spread across. Also through Vanguard, at the end of these years, we're going to want to reallocate our funds so that our money is evenly split between mutual funds and index funds so that not too much risk or too much value is placed on one singular fund in order that if that fund fails, we do not lose a large portion of it. Moving on to years 6 through 10, our investment money has increased at an annual rate of 3%. So now in these years, we have money to invest $350-ish a month to invest. And now that money has started growing in our funds, it is important that we begin to mitigate risk. And in order to do so, in these years, we're going to purchase one bond fund. This bond fund will mitigate risk because we have more assets, so our risk is spread out. And bonds, although they have a lower return rate than stock funds, they are actually less risky, so that is why we are investing in one. And here is a graph of our asset allocations. Bonds would take up 14% of our portfolio, international stocks take up 28%, and U.S. stocks take up 58%. Years 6 through 10 details. In year 6, we will be purchasing our bond fund. Our bond fund, labeled Fund G, has a expected return of 7.26%, which is lower than the international stock funds and the U.S. stock funds because it is less risky. There's less risk involved when taking a bond fund. We will have to save up for this fund because the minimum investment for a fund in Vanguard is $3,000. Also, it has a 1.00% purchase fee, which we will have to pay the fund. And here's a graph of how we expect $10,000 to grow in the course of 10 years. Years 6 to 10 recap. Now we have 7 different investments made through Vanguard. We have 1 bond fund, 4 U.S. stock funds, and 2 international stock funds. Since we're getting older, this money will continue to grow, and the total value of investments at this point is roughly $86,000. An overview of years 11 through 15. Now our money per month has become to roughly $400 a month to invest, and since our money has begun to grow so rapidly, we decided that it's time that we eliminate risk factors in our portfolio. To do so, we are going to invest in 1 more bond fund, and that makes us our asset allocations at this point 50% U.S. stock, 25% international stock, and 25% bond. All right, in years 11 through 15, after allocating our funds so that each stock or each fund is balanced so that not too much money is in one fund, and if that fund fails, we will lose a great portion of our money. So we made sure that Vanguard reallocated our funds so that all of our money is evenly distributed within our funds. We will purchase Fund H, which is another bond fund. What I really like about this fund is that it's inflation protected, which means that because of bonds, they're susceptible to some risk with inflation through the money market, but what this bond does, it makes sure it protects us from that, so it has an even lower risk factor, which is great for our portfolio because we do not want that much risk going into year 15. Summarizing our years 11 through 15, the total value of our investment now has been calculated to be roughly $165,000, which is great because that's well on our way to make $1 million. And now at this point we have 8 different investments through Vanguard. We have 2 bond funds, 2 international stock funds, and 4 U.S. stock funds. It's also important at this point, year 15, that we reallocate our funds so that each fund has the same amount of money in it, so that if one of our funds were to fail, then we would not lose too much money. All right, in years 16 through 20, our monthly investment money has increased to $467 per month, and since we now have a lot of money, we need to yet again cut down on risk factors. To do so, we are going to get rid of one of our international stock funds because the international stock funds are the riskiest out of our funds, and we are also going to replace one of our U.S. stock funds with another bond fund because bond funds have a lower risk than any stock fund. So our asset allocation would be 43% bonds, 14% international stock funds, and 43% U.S. stock. All right, getting into the years 16 through 20 details. In years 16 through 20, we are going to sell Fund C and Fund D, and with that money, we are going to replace it with Fund I, which Fund I is a bond fund, a bond index fund actually. So it has a low expense ratio, and we are going to make sure with Vanguard automatic investing that our monthly income is evenly distributed within our funds each month. Years 16 through 20 recap. At this point, our total value of investments has come out to roughly $290,000, and at this point we have 7 different investments. We have 3 U.S. stock funds, 1 international stock funds, and 3 bond funds. So our risk factor is being mitigated greatly. And also at this point, we want to make sure that the money in each fund is equal so that if one of the funds fails, then not too much of our money is lost. 21 through 30, Our investment money per month is now $542 a month, which Vanguard will continue to invest into all of our funds equally. And in year 21, we are selling our last shares in an international stock fund, and we are also selling our last shares in one of our U.S. stock funds. So our asset allocation now will come out to 33% U.S. stocks, 50% bonds, and a new fund that we will invest in, 70% the money market fund. Because a money market fund is very, very low risk factor, which we need in our portfolio. They're low risk because the value of currency changes very, very slightly, or not at all. So there's little to no risk involved with a money market. All right, some details behind years 21 through 30. In year 21, we'll sell our shares in Fund E and Fund A, and we are going to be purchasing a new fund, which is a money market fund. And in this fund, it has very low expected return rates and very low risk factor because money rarely changes. And in the rest of these years, we will be continually investing every month, and Vanguard will be sure to split up that money equally to distribute to our 6 different funds. Years 21 through 30 recap. Through 30 years, we've already calculated that we made roughly $800,000. So that means we are very, very close to our goal of $1 million. And it shows that it's very easy to get to that goal. So at the end of 30 years, we now have 2 U.S. stock funds, 3 bond funds, and 1 money market fund. And in order to keep the money in each fund equal, Vanguard will reallocate our funds so that there's equal amount of money. Last investing time period, years 31 through 42, our monthly investment money has now grown to $730 a month. And because we have already made so much money, it is so crucial that we eliminate any risk factors that we can. So, because at this point, money loss would just be too difficult to make up before our retirement age approaches. And to do this, we are going to sell the remaining U.S. stock funds that we have and reallocating our money so that the money market fund has 50% of our money and our bond funds have the other 50%. Since these are the last few years of our investing, not much has to be done during these years. All we have to do is wait, and Vanguard will automatically invest our $730 a month equally distributed into our funds, and we just have to wait. So, all right, years 31 through 42 and retirement. So at this point, our final value of our investments has come to roughly 1.4 million, which is way over our goal of 1 million. At this point, also, we have 4 different funds. We have 3 bond funds and 1 money market fund. But through Vanguard, we're able to transfer this money into our savings account with no fees. And we can finally retire financially. Project conclusions and disclaimers. Through this project, we have shown that it's relatively simple to retire with $1 million if you are continuously investing throughout your life and you make smart decisions about risk. Since the future market can't be predicted, we had to make our calculations based on 10-year average returns, which we do realize is not 100% not 100% true or reliable to depend on, but we've shown that even with like lower return rates, that you are still within your goal of $1 million because we exceeded this goal with ease. Also, as long as an investor follows our decision-making process and our asset allocation that we showed throughout our project, they should have no problem retiring with $1 million. And a major takeaway from this project is how to mitigate risk. I thought that we properly mitigated risk, starting high risk and progressively getting lower and lower risk factors. And in conclusion, this project help us to realize the importance of long-term investing and starting early so that compound interest and continuous investing will pile up and we will keep making money. So that's our project. So thank you, and hope you have a nice rest of your day.